How we're going to work through exercise 3-1, which is preparing adjusting entries. As you know, we do adjusting entries at the end of the month to provide for certain expenses that may have been incurred or revenue that may have been earned. So the instructions are to prepare adjusting journal entries for the year ended, date of December 31st, 2015, for each of these separate situations. Assume that prepaid expenses are initially recorded in asset accounts like prepaid expenses, prepaid rent, etc. Also assume that fees collected in advance of work are initially recorded as liabilities like unearned revenue. So number 1, depreciation on the company's equipment for 2015 is computed to be $18,000. And here we can see the journal entry. This is the basic journal entry recording depreciation for any asset. You're going to debit depreciation expense for equipment. You're going to credit accumulated depreciation for the asset, in this instance, equipment. So note that we do not credit the asset itself. We're going to keep track of the depreciated amount in the accumulated depreciation, which is a contra asset account. It has a normal credit balance. On 2, the prepaid insurance account had a $6,000 debit balance at December 31st, 2015, before adjusting for the cost of any expired coverage. So we have paid $6,000 for insurance in advance of incurring that expense. So now we're going to look at the account to determine how much of that insurance has expired. How much do we need to record as expense? An analysis of the company's insurance policies showed that $1,100 of unexpired insurance coverage remains. So you have to read it carefully. It's not telling us the amount that has expired. It's telling us the amount that has not expired. So we're going to subtract the two amounts to determine the insurance expense. The journal entry is going to be to debit insurance expense for $4,900 and credit prepaid insurance for $4,900. Number 3, the office supplies account had a $700 debit balance on December 31st, and $3,480 of office supplies were purchased during the year. So that's going to be an additional debit to the office supplies account. At the end of the year, physical accounts showed $300 of supplies available. So we started with $700 plus we purchased $3,480. So that's what we put into the office supplies account. You can think of it as a supplies cabinet. During the year, we use it, we take it out of the cabinet, and now at the end of the year, we need to record how much is expense. So to calculate the amount, we're going to take the 700 plus 3,480 minus 300. That's the amount of our office supplies expense. We're going to debit office supplies expense, $3,880. We're going to credit the asset office supplies, $3,880. Number 4, 2/3 of the work related to $15,000 of cash received in advance was performed this period. So we have been paid $15,000 in advance. This would be unearned revenue. And now we have earned 2/3 of that. So 2/3 of $15,000 will be $10,000. So we need to record that we have earned that much revenue. So the journal entry, we're going to debit unearned fee revenue. So remember, unearned revenue is a liability. So to decrease it, we're going to debit it, and we're going to credit fee revenue. That's the amount that we have earned. Number 5, the prepaid insurance account had a $6,800 debit balance at December 31st, 2015, before adjusting for the cost of any expired coverage. So again, we've paid that much in advance. An analysis of insurance policies shows that $5,800 of coverage had expired. So this is worded differently than what we saw in 2. This one is telling us the amount that has been used up, the amount that has been expired. So that's the amount that we're going to record to the expense. So we're going to debit insurance expense, $5,800, and we're going to credit prepaid insurance, $5,800. And the last one, wage expenses of $3,200 have been incurred but are not yet paid. Since we have incurred the expense, we need to record it. So we're going to debit wages expense, and we're going to credit wages payable. The next exercise is a quick study 3-18. We're going to do the closing entries. It gives us the accounts. As you can see, it's just working with a few certain accounts, but it gives us practice on those closing entries. So there's 4 closing entries. First we close revenue, then we close expenses, then we close income summary, and then we close dividends. You can memorize those 4. They don't necessarily have to be in that order, but we do work with them in that order. So we're going to look at our accounts. We have one revenue account, services revenue, that we need to close. We're going to debit the revenue account. We're going to credit income summary. So since revenue has a normal credit balance, we want to zero it out at the end of the year to get it ready for the new year. So it'll start at 0. So to zero it out, we're going to debit the revenue accounts. The second one is to close any expenses. We have 2 expenses. We have wages expense and rent expense. Remember, expense accounts are debits. So to close them out, we're going to zero them out. We're going to credit these 2 accounts. We're going to add them up, and that's going to be our debit to income summary. So we're going to debit income summary for $10,000. We're going to credit wages expense for $8,400. We're going to credit rent expense for $1,600. The third closing entry is to zero out the income summary. So we had a credit of $13,000. We had a debit of $10,000. So to close it out, we need to debit income summary for $3,000 and credit retained earnings for $3,000. Note that this is the amount of net income for the year. So we've closed it out, and we have basically or effectively increased retained earnings for the earnings of the year. And the last closing entry is to close dividends. It tells us that dividends are $800. Dividends are a debit balance. So to close them out, we're going to credit the dividends account. Again, we want to zero it out, and we're going to debit retained earnings. That's reducing the retained earnings. So if you remember on the statement of retained earnings, the 2 adjustments that we make, start off with beginning retained earnings, we add net income, and we subtract the dividends, and that gives us our ending retained earnings. And the last exercise we're going to look at is quick study 3-19. Identify which of the following accounts would be included in a post-closing trial balance. The accounts that are on a post-closing trial balance, those are the permanent accounts. They're going to include your assets, your liabilities, and your equity. All of the other accounts are temporary and have been zeroed out. So you think about if you have cash on December 31st, you still have the same amount of cash on January 1st. If you owe someone some money and you have accounts payable of $1,000 on December 31st, on January 1st, you still owe them that money. So it's just going to continue. So on the accounts receivable, since it's an asset, it would be on the post-closing trial balance. Salaries expense would be closed, so it would not. Goodwill is an intangible asset, so it would be on the post-closing trial balance, as well as land as an asset. Income tax expense, that would be closed out, so it would not be on the post-closing trial balance. And salaries payable is a liability, so it would be on the post-closing trial balance. And that's the end of these exercises.